Given the U-turn in tax credits, we were expecting a lot more announcements on the tax side. However, given the government's longer-term view in the context of the spending review, on reflection, we're not entirely surprised at the minimal announcements. I think the government is considering that they will increase tax revenues over the short to medium term through three key areas. The general fact that the economy is picking up, so profits will increase and UK tax revenues will increase by virtue of that. Secondly, they are really looking to invest in tackling tax avoidance and tax evasion. They're looking to invest £800 million to give a return at least 4 times that amount. And thirdly, there are sort of medium-term measures where they're tackling the diversion of profits out of the UK, very much targeted at multinationals, but that should, in the medium term, bring significant tax revenues back into the UK. So overall, although we were expecting more, not overly surprised, although we would expect a lot more measures potentially to be introduced next year.
There was a lot of speculation in the media beforehand in relation to various reliefs that might be affected as a result of the statement, in particular entrepreneurs' relief. If it was anticipated that the limit at which entrepreneurs' relief would be allowed may be reduced from its current level of 10 million, or there might be increases in the actual rate of capital gains tax itself. At the moment, that still remains at a rate of 10% when owners sell their business or shares in their business. There was also some speculation that reliefs may be reduced for inheritance tax purposes, in particular business property relief and agricultural property relief. There was some thought that land prices had got too high because of various speculative purchases. Although the Chancellor only announced changes to dividend tax rates early this year, which take effect from next April, increasing the rate generally by 7.5%, it was thought that he may take the opportunity now to increase that further to say 10 or 15%. So this is something we're going to have to keep an eye on, and there may be further announcements next spring.
The main thing seems to be the continued attack on owners of second homes and those that buy to let property. We saw in the summer statement that there was a restriction of interest relief for mortgage interest where you have a property portfolio to restrict that interest deduction down for higher rate taxpayers over the next 4 years. And we've seen a continued attack today with an announcement that effectively says that if you are buying a second property, which you are going to let and it's residential, then there is a hiked stamp duty rate on that transaction with an increased levy of 3% above and beyond what you would normally expect for that level of transaction. We've also had some further announcements on capital gains tax where residential property is disposed of in terms of the time that you need to settle your tax liability. Currently, if you dispose of a residential property, your capital gains tax is payable under the normal self-assessment deadline, 31st of January after the year of disposal. What we now know is that that will become 30 days after the date of disposal, which means you will be paying your tax bill on capital gains tax a lot earlier. Now, it won't apply to your principal private residence, so because that's exempt from tax anyway, but it does mean, again, it's another issue for those that own a second home or those that have residential property portfolios, so they will now have to pay any capital gain tax arising on a disposal of a property 30 days, much earlier than previously.